Now let's talk about area patterns and consolidations. So the first type of correction we talked about was a correction in price, and that's why we either looked at support levels or using a Fibonacci to make that assessment. Now we're going to talk about the sidewinding type of corrections. And these are called area patterns. So area patterns or consolidations, another way to call them, are depicted by sideways moving markets. Okay, now they could be irregularly shaped or they could be very jagged, but ideally they are moving sideways in a sense. Prices pause in this pattern because they need time to be able to fix that extendedness that the prices had shown earlier. So if a stock price attempts to move up, for example, let's look at this. So if a stock price like this moves up very, very quickly, it stops and it pit stops and it generates a sideways motion in price, just like what you see here. And what it does in there is it gives avenue for some people to take some profits. It also gives the other end, which is people waiting to buy, an opportunity to buy that stock. Instead of having to chase it, at least it's winding up. And that should be able to give them a fair amount of comfort because they can now see what their low sides are rather than buying somewhere here and knowing that your support is way down here. So what happens now is the stock starts to sidewind. And in there, it's regaining some energy. Whether that's energy to push it up or to push it down, we'll find out later on. But in this particular case, it happened to be on an upward move. So what happens here is we're waiting for this consolidation to finish or this area pattern to finish. You have two options while you're doing that. You could range trade this pattern if it's big enough. So for example, you'll be buying on the low side, selling on the upside, buying on the low side, selling on the upside. Or if the range is too small, then you have no choice but to just simply wait for this to break out. A breakout is called a pushover resistance like this in a pattern. And in a breakout condition, that tells you that the trend from a sideways motioning situation is now back into an uptrend. And you can now start buying the stock again because the uptrend has come back into place. Now, let's look at an opposite condition. Let's say your stock price was falling, it becomes oversold, and now it makes a recovery and parks itself for a while. And you can see a much more longer consolidation sideways here. And it moves from support and resistance inside that set band. Again, if the range is big enough, you could buy towards support and you could take profits closer to resistance. But normally, if I see that the main trend is down, I usually don't do that. I will only do the range trading if I see that it's generally on an upward path, so that just in case the prices do break out, it provides an avenue for me to have that extra punch into the profitability side. Because here, if you call it wrong, you could walk out with a bleedy nose because you're actually trying to buy this into a general downtrending situation. Now, once the support into a pattern like this is broken or a consolidation break like this takes place in support, we call this breach a breakdown condition. Now, a breakdown condition means a sideways market has now turned back downwards and that an avalanche of selling is getting ready to take place. And normally this is the reason that in a breakdown condition, we are really looking to sell our shares to protect whatever profit we still have or the value of what we have inside our position. In a breakout condition, we're looking this for potential buy because it tells us that a new uptrend is coming back and we want to be able to get a bit more aggressive into this position because it tells us that since a new uptrend has been reignited, that we may be able to make more money as the stock continues to move higher. So again, breakout should be able to lead to a consequent buy, while a breakdown should lead to a consequent sell. Now, I want to also tell you about volume because as I told you in our last episode that volume along with price are the way we will be looking at prices. Now, volume gives a third dimension into price. Now, normally when activity like this is high, you'll get a lot of people trading. Volume levels could be quite decent if not high. But when consolidations like this begin, the tendency for volume is start to drown itself down or to narrow itself because less and less people become interested in a stock price that's not moving or it's sideways spin because it's very hard for them to make money. But that also gives us a clue that if that volume levels becomes too dry, it could also tell me that the potential move may be coming because there's no more shares to be sold and that more impact on the trend move may come up very, very soon. So it's something that we want to come and look at. Also, in a breakout condition like this, volume levels should start to improve or enlarge. And that should be testament to you that more following is coming to the stock. And that's quite helpful because at least it tells you that demand is following along with you, and they will be your backers to keep that propelled into an upside. Or if that happens to be in a downward market, that tells you more volume coming in and more volume pushing the stock price down. And so that should make the trend more lasting. But if the volumes are very fickle or very narrow in a trend move, then you should judge that there could be an end to this coming soon. And that's why we look at volume along with the movement of price charts. All right, let's go back into those area patterns. Now, when we talk about these other area patterns, it's important to be able to take two things off these particular patterns. One is the shape, second is the size. Now, when we talk about a shape of an area pattern, I am talking about the geometrical shape of what that pattern looks like. So let's have a look at this sample right here. Here, we have a price swing going up and down, up and down, up and down. You notice that the tops tend to share the same general zone, and the bottoms also do the same. And so we have a flattish bottom with a flattish top. And let's just look at that in terms of supply and demand. Resistance is an area of supply. It's an area where there's a lot of shares that are being unloaded by people who might think that it's a good price to sell at. When we talk about support, we're talking about an area of demand, an area where there's supposed to be a heavy amount of concentrated buying taking place. And here, a lot of people want to buy because they feel maybe the price is decent, or because maybe they've seen a low there before, they might think it might happen again. And so as these support and resistance areas test and prove themselves more and more over time, the stronger they become. Now, look at the shape of this. You can see a flat bottom and you can see a flat top. Let me contrast that with this next sample you see here. Here's a different type of area pattern. The tops are the same, just as this. They're also flat. But if you were to look at the bottom range, as you can see that this is not a flat bottom anymore. You can see that the low was once here, and the next low has made a higher low. And you can see by connecting these two together, I have a demand line or a support line that's climbing. Or if you'd like, a support line that's getting more intent or stronger, as compared to your supply line, which is only flat, or your resistance line, which is flat. Now let's talk about what that means by looking at the shape. So if I were to describe to you how is support or demand taking place here in the first example, that means the people who want to buy this only want to buy it at that price. They're not willing to raise their price to buy this stock. Only if the price comes back down to this price will they buy. So you can see that that support or demand is relatively neutral. The seller is the same. So the resistance or supply situation with the seller tells you the seller only wants to sell at this price, and he's not willing or she's not willing to sell the price lower. And because of that, you have a relatively neutral supply line or neutral ability for the seller to go out. Now, why do I want to call it that way? Was it neutral or is it aggressive? The reason is this will give you a good sense of how strong the movements of the market are showing you. Is the market force in favor of demand, or is the market force in favor of supply? In this case, it's neither one of the two, because your supply or resistance is just flat and so is your support. And since these two don't want to push prices against each other, then what's going to happen here is a battle of attrition. Whoever loses their shares or whoever loses the amount of money to buy, eventually they will win the war, right? Then that's how you will wait for this to happen. But in the second situation here, you look at demand. Demand is slowly picking itself up. That means the buyer here wants to buy higher and higher, maybe because he has a much more firm need to accumulate those shares. Whereas the seller standing here is only willing to sell it at that price. Eventually, the buyer will reach over to where that seller is, and he will now contend with them and say, if you really want to sell it there, give it to me. And so now here you have the aggressor, the buyer, as compared to a neutral seller. If you were to look at this in that simple sense, you could probably say that since demand is rising faster, more intently with greater force, then there's greater chances that once this meets together, that push prices way up here. That's why 85% of the time, if you see a pattern like this pattern is called an ascending triangle, that 85% of the time, this will break out top side and allow this uptrend to continue. Whereas in a case like this, 50% of the time it will go up, 50% of the time it will go down. We will give it a little bias depending on what the previous trend was though. So for example, if this goes into a sideways move and the prior trend was up, we'll give it a slightly bigger chance that the potential for this is to continue going up because we'd like to give that chance into what trends are. In this case, it's very clear that the upward movement will break over this over in due time. So you should be leaning toward the potential for this to climb. Now let's talk about the height and length of an area pattern. Now the vertical distance from the low to the upper end of an area pattern is also something we will account for later. We call this the height of the pattern. And when you draw one, you should always drawing upon the highest point, not the narrowest point like it would be over here. And we'll do this because we will try to measure what an up move or down move will be later depending on this vertical size that you have. Now, why do we want to see the horizontal length? The horizontal length of a pattern will give you a sense of how long was the winding phase taking place. Imagine you have a wind-up toy with you, and you're winding up the key on that. And as you wind it and wind it and wind it even more, in this case, it consolidates even more. It generates more power and more explosion power later on when it comes out of that area pattern later. So the longer the area pattern, the greater the consequence of that push that will come out later. Also, the wider, the more vertical space you have in an area pattern, the more substance you can carry a breakout or breakdown condition from that pattern. And we'll study those measuring formulas later.